Good afternoon everyone. Welcome to another session on dollar INR, and today I want to talk about dollar INR volatility and how we can use this volatility of dollar INR for our decision making purposes. Okay, so the markets have been relatively very static if you look at this particular period. Okay, I will try and zoom that also. But what we have seen in the last 11-12 trading sessions, the INR has been extremely static. The average high-low range has been just around 9 to 10 paise per day. Okay, so that's like a very small trading range for the day. And what has happened because of this tight range-bound trading is all the volatility indicators. Okay, all the volatility indicators have converged. I want to show you two lines. Okay, there are a set of two lines. One is the standard Bollinger Band. Bollinger Band is an indicator that gives an indication of the volatility of that particular asset. And since we are talking about dollar INR, this is about volatility of dollar INR. So if you look at these orange lines, okay, these orange lines are gradually converging. Okay, that is a standard 20-day and two standard deviations. I want to also point out to the other Bollinger Band, which is a faster Bollinger Band that has a setting of 15 days and 1.5 standard deviation. And if you look at the red and the green line that is indicated by that particular Bollinger Band, that have converged significantly. Okay. Now another indication of reducing volatility is what we call as the average true range, the ATR, the average true range. If you look at the ATR, it is at such a low 17 to 18 level, 0.17 to 0.18 level, and if you look at the chart, that is the lowest level since the beginning of 2025. Okay, so the volatility or the ATR indicating the dollar INR volatility is at the lowest level of this current calendar year 2025. Okay, and that is a very strong indication that the volatility has cooled off substantially. Let me try and get this chart. This is the chart if you look at it here. Okay, let me try and zoom it perfectly. Okay, so if you look at this particular period, now this period is when the volatility had converged substantially. Okay, the last 11-12 trading sessions, and that is why we are saying that the volatility has converged, because the trading range has narrowed substantially. Now how do I use this in my decision making is the next big question. Okay, now this is a table that I constructed and I wanted to show some kind of an analysis for decision making. Okay, and here I want to talk about vanilla options. I have created a lot of videos on vanilla options. Please do have a look at it. And today again I want to re-emphasize the use of vanilla options to hedge the dollar INR risk. Okay, now look at this data. What I have tried to do is I have computed the vanilla option premium. All of us know that if you take a vanilla option, you have to pay an option premium, and that is the hedge cost. That is the cost that we need to pay. So since it is a cost, we need to look at how are the situations of reducing that cost as much as possible. Okay, so we looked at 4 different cases. The first case that we looked at was today. Okay, today the dollar INR spot is 88.78 and I am looking at a 2-month option. Since I am doing a 2-month analysis, I get a forward rate of 89.08. Okay, and if I take the option today for 2 months, I have to pay a premium of close to 49 to 50 paise. Okay, per dollar, 49 to 50 paise per dollar, and that is around 0.5% as a cost to the spot. Okay, it is 0.5% to the spot. What is my option premium? Now what we need to look at very closely is how has this option premium behaved. Let's take 1 month ago, okay, 2 months ago, or 3 months ago. Okay, because since it is a cost that I need to incur, I need to look at the time when the cost has been the least. So I am trying to evaluate, has the cost been least since the volatility has come down. Typically when volatility comes down, options become cheaper. So I am trying to evaluate is the option is really cheap now. Okay, so we just figured it out that for 1 month, sorry, not for 1 month, for 2 months, the option cost is around 49 to 50 paisa. Now, if I look at 1 month ago, that time the spot was around 88.08. The 2-month forward rate was around 88.36. And if I took a 2-month option, then the cost was 60 paisa. Okay, now it is around 49.50. That time it was 60 paisa. And similarly, if I look at 2 months and 3 months ago, the cost of the options were in between 60 to 65 paisa. Okay, and that is the catch, that is the value that you need to look at. Okay, a 2-month option, again option where my strike price is equal to the forward rate. Okay, I am not going in the money or out of the money, I am choosing a strike price which is equal to the forward rate. So for that strike price, the option cost, which was earlier in between 60 to 65%, just about 1 month, 2 months, 3 months ago, the cost 2-month at the money option cost was around 60 to 65 paisa, and today that cost is around 49 paisa, and the primary reason for that is the reducing volatility that I showed through the Bollinger Band chart just a while ago. Okay, so the conclusion for dollar INR, for managing the dollar INR risk in current times, is to use a vanilla option. Again, first very big advantage, it gives you unlimited benefit if the market moves in your favor. If the market goes against you, obviously it gives you that protection, and all at a cost of around 49 to 50 paisa for 2 months. The same cost a month ago or 2 months ago was around 60 to 65 paisa. So the vanilla option cost has come down, it has become cheap. So you get unlimited benefit at a cheaper price. So that is what you need to do. You can also evaluate forwards as a hedging instrument, but some portion of vanilla options certainly needs to be done to manage your forex risk more effectively. So that's it from my side. Have a great day ahead, and if you want more such insights on currency markets, please join our WhatsApp community.